Uganda's debt could soar to 53% this financial year, above the debt to GDP threshold, which could upend an economy rebounding from the ravages of the COVID-19 pandemic and a blip caused by the geopolitical conflict in Eastern Europe. Suffice to note, debt to GDP ratios are projected to go slightly above the 50% policy threshold by the end of financial year 2021-2022 and to peak at 53.1% in financial year 2022-2023, the Auditor General observes in his report for the 2022 financial year. The debt to GDP ratio is a measure that compares a country's total debt with what it produces. The ratio reliably indicates a country's ability to pay back its debt. A high debt to GDP ratio may make it more difficult for a country to pay both internal and external debt, and may lead creditors to seek higher interest rates to compensate for financing risk due to likely default or unnecessary debt extension. Though the IMF has recommended 50% as the point of safety, many developed countries have gone up to 200%. However, according to the IMF, developing countries are more prone to economic shocks and exchange rate risk, thus limiting them to 50%. Experts are warning that unsustainable borrowing could snowball towards the debt stress trap, pushing the economy projected by the IMF to grow at 5.3% towards the cliff. The Auditor General, John Mwanga, warned in the report that public debt is continuously on the rise, a fact that is attributed to persistent budget deficits, rollover of liquidity papers, bond switches, private placements, new borrowings for various development projects, and foreign exchange losses arising from the depreciation of the shilling against stronger currencies. The figures from the Auditor General's report show a consistent increase in the total debt, as evidenced by an increase of 109% in the 5 years from 2017-18, where it was 41.4 trillion shillings to 86.6 trillion shillings as at 30th June 2022. This has also greatly impacted service delivery, as a large chunk of what is collected by Uganda Revenue Authority is injected into payment of loan interests. The Auditor General's report reveals that during the financial year of 2022, 24.1%, an equivalent of 5.5 trillion shillings of the revenue collected, was utilized towards interest payments, and 1.4 trillion shillings in principal debt repayment, representing 6% of the domestic revenue collected. About 30.1%, which is worth 6.9 trillion of the total revenue collected, was used to service the debt, leaving only 69.9% worth of the 15.93 trillion shillings available for funding other critical government expenditures. This left a paltry amount available for service delivery, which constitutes 30.89% of the total revised budget of 51.56 trillion, implying that 69.1% was financed by grants and loans. An economist, Abubakar Mayanja, argues that for an economy to rebound from a tailspin, investment is key to create a stimulus. But he fears that too much debt may lead towards debt distress, and this may cripple investment in the most productive sectors in the economy.
And when you look at the budget of Uganda, it has been growing in nominal terms year on year. And so the demands on the government to meet its own obligations for recurrent expenditure, even, say, the payment of the members of parliament and its public service and running the government, if you also put the pressure of debt service, then it becomes a bit difficult fiscally to operate.
Fitch Ratings last month revised the outlook of Uganda's long-term foreign currency issuer defaulting rate from stable to negative. The revision of the outlook to negative reflects heightened fiscal and external financing and liquidity pressures, partly related to reduced availability of concessional external financing, tighter domestic and external financing conditions, and large twin budget and current account deficits. These pressures are evident in declining foreign exchange reserves, a scheduled increase in debt service payments, rising government interest costs, a less favorable public debt structure in some respects, and a rising net external debt to GDP ratio. Fitch offers sovereign credit ratings that describe each nation's ability to meet its debt obligations, And sovereign credit ratings are available to investors to help give them insight into the level of risk associated with investing in a particular country.
The ratings are going to come from the fundamentals we've been talking about, like your revenues, your expenditure, and your capacity to pay back. So when you look at Uganda, one of the impacts is our capacity to generate foreign currency, because some of our debt is in foreign currency. So if the export base is not growing, if our capacity to generate foreign exchange is not so high, then the rating will go down. We've seen some examples of even resource-rich countries that have had payment distress.
A confluence of events could further complicate recovery, as the acting director for budget at the finance ministry, Ishmael Magona, warned that the country only has about 24 trillion shillings out of the total vote of 51.6 trillion. As a result of Uganda's negative ratings, it could borrow at higher interest rates if it seeks to borrow from the Eurobond, as Kenya has done in the past. A Eurobond is a bond issued offshore by governments or corporates, denominated in a currency other than that of the issuer's country. Eurobonds are usually long-term debt instruments. But the Deputy Secretary to the Treasury, Patrick Ochailap, told Daily Monitor newspaper that debt was manageable and government will not seek a Eurobond.
But I think as of June 30th last financial year, it was 48%, just 2 points below the 50% threshold that we had set ourselves to, which is a very big achievement, because it's very important for us to realize that while debt per se is not bad, a rapid accumulation of debt, both domestic and external, by whatever measure, is not good.
He, however, argues that the country ought to be rational in contracting debt and it should be spent across the productive sectors of the economy.
Calculative in contracting debt and ensure that whatever we contract goes to those areas of the economy that help the economy to grow. And once the economy grows, the expected return on that investment should be able to make you generate income, which then you use for paying debt. So the ratio of the earnings of the economy and the growth of the economy to the expansion of the debt should be seriously curtailed.
To deal with galloping inflation, the central bank adjusted the central bank rate in Uganda from 6% in 2022 to 10% currently. One of the fiscal measures that the government undertook, according to Ochailap, was to improve efficiency in tax collection and austerity measures that halted wastage on travel abroad and workshops, amongst others.
What did we do from the fiscal side, from expenditure and revenue? We continued our emphasis on revenue collection. We did not increase the revenue rates, the tax rates. We maintained them at the levels of the previous year, but we improved upon the efficiency of URA to collect more. And I think that response was very good because it gave certainty to the economy that when faced with difficulties, the worst thing can do is actually to increase taxes, among others. What we also did on the side of expenditure is certainly to cut expenditure on areas that we thought would not directly contribute to immediate growth in the economy, which are consumptive in nature. We cut expenditures in things like travel abroad. We cut expenditures in things like workshops and seminars.
Ochailap estimates that these austerity measures will result into savings worth 242 billion shillings, which shall be repurposed to productive areas like the parish development model, agro-processing, NADS, and community roads to move produce from farms to markets. Recent debt sustainability analysis reports by the Ministry of Finance and the IMF show that Uganda's debt is sustainable, but at moderate risk of debt distress in the medium and long term. However, an economist at the Economic Policy Research Center, Linda Nakato, warns that Uganda could be caught up in a public debt safety trap.
What you realize is that it is not as comprehensive as it should be in order for us to get a true position of how we are performing. Because, of course, there are several other different factors that influence our debt sustainability position and hence our decision to borrow. But why we thought that this may give us a false sense of security is the fact that it has a limited scope. Because if we are to go into the different factors, like basing on the monetary and the macroeconomic factors, basing on the several other institutional factors, basing on governance, because we know that we have a lot of corruption issues. So if fiscal management challenges, if we base on all those, then realize that we have a bigger challenge.
Service a debt in Uganda comes from two sources. Because we pay in foreign currency, we have to always be able to generate either FDI or aid inflows in hard currency, in USD or euros, to be able to pay off our debt. Now, in the medium term, Uganda is expected to be an oil-producing country, and that problem won't be there. So the risk is in the short term as to whether we can have enough dollars or reserves in the central bank to service our debt. That is the concern. And usually the impacts of how much dollars we have also come from the import side. So if you take an example of our biggest import, which is refined petroleum, the price has doubled, which creates a higher demand on the USD. Now, if we don't double the amount of coffee that we export, then the risk is not that we won't have the money, but we will have either the Uganda shilling will depreciate because of the high demand of the dollar in the local market, which then will worsen the inflation problems.
Countries are caught up in a public debt safety trap when a favorable debt position based solely on debt sustainability analysis results increases their borrowing appetite and carefree fiscal behavior, especially when the public debt is still below the set national or international debt limit. This is primarily fueled by the pseudo-safety due to more fiscal headroom to borrow, especially for countries overly relying on debt sustainability analysis results to assess debt policy sustainability and make borrowing decisions.
These limits are set to help us, to prevent us from going into a position where we are not able to pay back, or we affect service delivery, because debt has an impact on service delivery. For example, currently the total debt to percentage of the debt for the budget, 30%. So you can imagine that takes up the biggest percentage. It takes away from service delivery, education, and health, which are key. So the implication of us not following our the rules that we set down, for example, in the Charter of Fiscal Responsibility, in getting loans that are non-concessional to pay, to do supplementary budget, the constant, for example, supplementary budgets, realize that it takes away from things. For example, I'm just giving an example of service delivery. And then, of course, it puts us at a risk, because then you're getting loans that mature quite early and then they have high interest rates. So that means, again, debt distress. You have to dig deep into the coffers to pay up that debt, and also has various implications even on our forex reserves.
The Auditor General also disclosed in the Statement of Financial Performance that domestic arrears exponentially rose from 4.65 trillion shillings in 2021 to 7.5 trillion shillings in 2022, constituting a 62% increase. Usually the borrowing rates in the domestic market are higher compared to International Development Association concessional terms that offer low interest rates. Mayanja says domestic borrowing is dictated by the prevailing conditions in the global markets.
The root cause of domestic borrowing is the structural fiscal deficit, where government always has a higher expenditure than the revenues it generates from taxation, and it has been increasing. So the demands of the government in terms of its need for money, once they exceed its revenues, then it goes into the market to borrow. But as you are aware, the prevailing conditions in the global markets have changed. So for example, the US has increased interest rates highly to control inflation. So the cost of borrowing is a bit higher. And also there was a little bit of fatigue as the countries that we traditionally borrowed from also had a crisis of their own, the pandemic.
He says the perils of domestic borrowing create a scenario where the private sector, from which government generates taxes to pay its debt, doesn't have the opportunity to grow because the capital is more expensive, because government is borrowing this money at a high rate.
Which is a good thing, but also it comes at a cost. And that cost is that even the private sector is competing for the same funds, and the banks prefer to lend to the government. So it creates a scenario where the private sector, from which the government generates taxes to pay its debt, doesn't have the opportunity to grow because of lack of access to capital, or because the capital is more expensive because the government is borrowing this money at a high rate.
As a result, one of the structural problems that arises is that most of the savings that should have gone in long-term investment end up in short-term government instruments, and that limits the expansion of the economy. Ochailab says that they have cut back on borrowing this financial year. He says there are both monetary and fiscal policy measures that have been enforced, but policy wonks have resisted the temptation of subsidies.
Guys, what are you doing? If our neighbors are giving subsidies, why don't you give subsidies as well? Remember that argument? We stood our ground and said, no, it's not a very good, you're not supposed to play to the gallery. You're not supposed to play a chorus. It's not a beauty contest. We elected the option of being cautious by not doing nothing, but by doing something in terms of cut back on expenditures, improving our efficiency in revenue collection in support of the monetary policy side where interest rates were increasing in order to deal with that animal called inflation. I think we have been borne out. As we talk now, inflation is receding. It's now below 10%. It's back to single digit from double digit where it had gone. Interest rates in the domestic market also, I think, should be abating to some levels. The commodity prices have also responded positively. Our exchange rate has been stable apart from the recent times when, because of seasonality factors, it started to pick up again.
The tax body is seeking to roll out a raft of tax reform proposals contained in 6 recently tabled bills in the August House. But there are fears that these taxes could disincentivize the few shouldering the tax burden. And in Mayanja's view, it is an attempt to kill the goose that lays the golden egg. The Auditor General also listed a number of contracts where government had lost funds worth billions of shillings as a result of the cancellation of the contracts and commissions which accrued as a result of unspent funds meant to be spent on these projects. For instance, the contract for the construction of the Muzizi hydropower dam was cancelled after government had paid a total of 3.967 billion shillings in commission fees to the German Development Bank, KfW. I noted from the date of execution of the said loan to the cancellation, the government of Uganda had paid to the KfW a total of 3.967 billion shillings in commission fees for unutilized funds. This in effect caused a financial loss to the government of the said amount, as there was no benefit for the said money. The failure to absorb funds therefore can be categorized as nugatory expense, reads the report. In a letter dated 14th July 2022, the KfW indicated that the total amount payable on the loan was €1,171,875, equivalent to 4.657 billion shillings, as cancellation and commitment fees. The audit noted that the initial agreement entered into by the government of Uganda and the KfW had a drawdown period ending on 30th December 2021. Following the lapse of the drawdown period, the government successfully secured a renewal of the facility. The Auditor General says this anomaly amounts to unnecessary payment which could have been avoided either by allowing the facility to lapse or not renewing it before cancellation. There is no evidence that the minister sought the advice of the Attorney General before the cancellation process was undertaken. A review of the status reports provided to the Finance Ministry by UEGCL on the execution of the project revealed that funds totaling 2.695 billion shillings have been doled towards the compensation of project-affected persons and acquisition of land. The report also revealed that billions of shillings have been doled out in commissions as a result of unspent funds for the construction of the Kampala-Jinja Expressway and Tororo-Gulu railway line. Borrowing isn't necessarily bad. However, it must be dispensed in productive sectors whose domino influence will inject growth in the economy. This is proven by cost-benefit analysis of projects that are financed by debt. From Ghana to Kenya, the radical effects of uncontrolled borrowing are in plain sight. The government should not borrow from the domestic market as it crowds out the private sector. Christopher Paulo Kayonga, NTV, Panorama.